Okay, so let's see. You're going to get the hook at 2:15. So I'm going to go back to my top 40 DJ thing and try to rocket through some slides on the early stages of customer discovery, a little more detail on, well, what? Okay, you keep saying get out of the building, get out of the building. What do I do when I get out there? And all of these slides will be available to you either on some website or they'll be emailed to you or whatever. So if I, going a little fast, it's to allow us some more time for open Q&A, which is usually the most fun and the most helpful before they get the hook, right? So I've talked about a bunch of these really already, right? It's not just, do you have this problem or do you like my product? You have so much more to learn. But again, remember that every customer doesn't have every answer. So you've got to let the conversation kind of go with the flow. And it's not like you're sitting there with a list of questions. Okay, next, as you try to march each customer through all 9 boxes of the business model. Because some will have a better idea of how they want to use the product. Others may have a better idea of how they'll shop for or acquire the product or what the purchase process is like within their company, right? Which can often be incredibly complicated. I spoke to a young lady entrepreneur at the lunch break who is sure she's got a product that JP Morgan Chase will want to buy. Well, I had one too. About 8 years ago, I got a vest for it. And we were so sure this was a limousine dispatching and cost management online system that was used by dozens and dozens of smaller companies. And we needed one of the big New York banks to take it on. And we were sure JP Morgan Chase was going to buy it. They loved the product. And what's more, their venture fund had invested $3 million in this company. And like us, they got about 20 cents back at the end of the day. And we said, hey guys, all your operators, all your users and, travel managers think this product is great. They really want to buy it. And guess what? If you buy it, you'll help this company grow. You'll make money over here in your venture division. Then hem and hawed, meeting after meeting, everybody's going, yeah. Then we get the letter from the CIO. Sorry, we have a policy that's about 4 years old. We don't buy software from companies that are less than 5 years old. We've been burned too many times. They disappear on us. They don't QA well. So as much as we'd like our venture fund to do better, as much as we like your product, call us in 5 years and a month. So you have to understand how the buying happens in companies in your customer segment. And okay, so here's the next thing. Right? This is the question, we had it earlier from the gentleman somewhere over there. How do I know when I'm done with this customer discovery thing? Right, I'm asking people, I'm interviewing, I'm talking, I'm getting feedback and feedback and feedback. And we use this, right, all over this startup within GE. We now use it all over the world. The GE guy's question was, how do you put a little sort of quantitative, sort of accountability on this sort of, yes, interesting, yes, important, but still sort of fuzzy customer discovery process? And we're in a conference room, and I said, hey, how about we do this? And I drew a little circle in each of the 9 boxes, and you probably can't see this from where you're sitting, but down here in the revenue model box, right, it's a red circle. Red circle means I am not at all certain that I have figured out my revenue model. And inside the circle is the number 3. That's based on 3 face-to-face customer interviews. If you look at the green one, value prop, right? Green means, yeah, I'm pretty sure I got this one knocked. And the number in the middle is 25, right? So as I've talked to 25 customers, I'm hearing consistently they all think they would like to learn more about buy, get engaged with my value proposition. So I think it's pretty damn good. And so as these boxes turn from red to yellow to green, and then as the numbers go from 2 or 6 or 8 to 20 or 30 or 40, once you start to see a fairly consistent pattern of green circles with decent numbers, double-digit numbers in there, you can start to have some confidence that maybe you're really starting to, figure all of this out. I want to give you an example of a case from Stanford that has a particularly exciting sort of conclusion that literally happened about 2 weeks and 2 days ago. These were 5 guys, there was 3 at the start, were all Stanford engineers in laser optics. And they thought that they could train lasers to figure out where the 1-inch point was on a blade of grass and zap everything above an inch. And their sort of canvas said, we're going to sell this to Stanford University and other universities with lots of grass. That's not NYU, obviously. It has other kinds of grass, but not the kind that you mow. We are going to sell them the equipment, and that's going to be our business model. So they went out, and there's a sort of, visualization of what they did. So they went out and they did 20 interviews, right? And they talked to, municipal parks and rec people and municipal people and university campus guys, buildings and grounds managers. And basically what they found was, that's very nice, but we don't need that. First of all, we own all the lawn mowing equipment we'll ever need. Secondly, we have these guys who have lots of other jobs, and mowing the lawn is just one of them. Plus, we'd be a little nervous about having these unguided missiles driving around our campus day and night. So, thank you very much, not for us. Pivot, right? Pivot number 1. They went to a farm expo and found that the farmers who were blasting their crops with chemicals thought that was a much better solution than these complicated machines that cost tons of money and required, a PhD in electrical engineering to operate. So the regular farmers said no, and then they stumbled into organic farmers, where typical organic farmer has to weed the crop 3 or 4 times in one growing season, and you obviously can't use chemicals. You have to use farm labor, and you have to not look too closely at their Social Security cards or passports or other documentation, except when the guy pulls up wearing the INS hat, at which point your farm labor just vanished, which is pretty tough if you're trying to harvest next week, right? So 1 to 5 weedings per field per year, $250 to $3,500 cost per acre, assuming you can get the labor when you need it. And also the risk of, who knows where that guy's boots were before he's walking on the lettuce that's going to be on your table next week. So they said, okay, this is starting to sound a little more interesting, right? Forget lawn mowing. We need to teach these lasers not how high an inch is, but this is a crop, this is a weed. And have the first laser say, oh, that's a crop, do nothing. Oh, that's a weed. Trigger laser number 2, blast it, zap it, and kill it where it stands. And do this at a reasonable pace, moving down the, down the field. They showed it to more farmers. The feedback was fabulous. Then they got to the bottom right box about the revenue model. Yes, we want to sell you these. You'll probably use it, 40 days a year, and we need about $175,000 a machine. And the farmer's going, well, maybe those sort of illegals aren't so bad after all, and thank you very much. We'll think about it. Right? But they changed their value proposition, right? 100-to-1 reduction in the labor cost, food contamination risk goes away, solves the problem of do my laborers show up or not show up. And the segments were low and high density, organic only. Okay. They also found an interesting channel. There are people who sell farm tractors and, plows and things like that, called, farm equipment dealers, oddly enough. There are also people who will come in and harvest your wheat or your corn or whatever for you. They show up with all the, equipment. They harvest it, they carry it to the grain elevator or the processor, and they send you a bill and they go away. Interesting channel opportunity that came out of some of their learning, and they were still sort of stuck on selling the equipment. So they went on to further conversations, and they found the ultimate business model, which is we will show up with this equipment on a truck with an engineer who can fix it if it breaks down and an operator who will keep it moving up and down your rows, and you will pay us by the weed density by the acre. So high weed density costs more than low and so forth, but it's a service rather than a capital purchase. And the happy ending to this story is 2 weeks ago, Thursday, $3.1 million Series A from a top-tier VC firm in the Valley, Excel Partners, on an idea that is less than a year old, tested and worked and pivoted, as you saw, a good number of times from the customer discovery process. So the first time you go out to do your customer discovery, it's really all about, does anybody care about this thing I'm about to invest 5 years of my life doing, right? And your primary mission is test the problem. Does anybody care? To the extent you can find out some of this other information along the way, even better. Then you bring that information back to the office and you do your third-party research, your Google work, you look at trade publications, you look at industry and analyst reports and things like that, and validate your findings and make sure that if, for example, you heard that, this is particularly good for organic rutabaga growers and you're patting yourselves on the back and high-fiving, oh my God, we're going to control the rutabaga industry, and then you do a little bit of clinical sort of online research and you find out that the rutabaga business is about 40 acres of rutabagas and they're spread all over the country, so you're going to have to truck your equipment from A to B to C if you can even get the business. So how do you validate what you've heard from customers with what you learned from industry research, and so on? Again, I think I've said this enough times, you're not selling, you're listening, you're asking why this, why that, why don't you like my idea, what does it better for you, and so forth. And along the way, how would I get your attention? How would I create demand for my product, if I could, okay? When you go out on this exercise, one of the important things you want to do is have some metrics of success in mind. In other words, if you go talk to 10 people, 10 of them aren't going to say, oh, this is the most horrible problem. It's been keeping me up nights for a year. Where have you been all my life? I am so desperate to solve this problem. It's just not going to happen, right? But are you hoping 2 in 10 react that strongly, or 1 in 10, or 3 in 10? It's not necessarily a go, no-go decision for your business, but it's a benchmark so that the conversation at the end of discovery isn't, well, that sounded pretty good. Boy, that farmer, he was really excited. That one was pretty excited too. You have some sort of statistical, sort of inarguable data set. Well, we thought 3 out of 10 were going to love us. It was only 2.7 out of 10. That's not a failure. You may not change anything. You may just keep on going. But if you thought it was going to be 3 out of 10 and it's only 1 out of 10, you got to go back and do the math for your business all over again. Say, well, if we have to make 10 sales calls to get 1 order, that works fine if you're selling, you know, Lear jets or apartment buildings or, you know, Rolls Royces, but it doesn't work so well if you're selling $20 downloadable web apps or things like that. So how do you sort of balance not only the buy signals, but what about people who, wow, yeah, I have 10 friends who'd be interested in this. Are you hoping they're going to have 10 friends or 6 friends or 3 friends? And are they demonstrating a real willingness to broadcast your product, you know, to those friends? And as you have this learning, you sort of push it back through your very, very rough financial model and say, okay, these numbers still work pretty well. Or, well, I think we'd have to raise the price $1 because we're going to have to spend another $1 on customer acquisition. Or, gee, we're going to have some incentives to get people to refer it to our friends. Let's figure it's $2 a sale for that kind of incentive. Does the math still work sort of that way? Okay. One thing I haven't addressed at all is the differences in discovery between physical products sold in physical channels and web and mobile products obviously sold most of the time in web and mobile channel. And the difference is really, and I don't know if I have another slide here or not, but obviously your customer relationships are very different, right? You're face-to-face selling in the physical channel. You are totally invisible on the web and mobile channel, but everybody's dream is to get their app on the App Store, right? Oh man, I got this fabulous iPad app. I get it on the App Store, I am rich. You and 900,000 other people believe that. And having your app on the App Store is somewhere up there between being in the bottom corner of the darkest shelf in the farthest corner of Walmart and, you know, kind of kissing your sister. All you have is a product on a shelf. And unless your app rockets into the top 10 in the category, and it's a category that matters, or you get an immense amount of press, you're just sitting there waiting for magic to happen, and it's not going to happen anytime soon. And it's sort of, when you think about channels, the web and mobile channel is so benign. All of the burden is on you to drive customers to your product. Not much of the, 100% of the burden falls on your shoulders. I can't tell you how many times people have told me about these months they've spent building this beautiful website and nobody comes. Why is that? We've got this great site. It's the best site for baby care or health care or pick your flavor. And nobody comes. Well, you forgot that you still have 90% of the job yet to do. And the same is true in the physical channel. Getting into Walmart doesn't really accomplish much other than if somebody knows that your product is there on the shelf, maybe they can go and find it. So who do you talk to for customer discovery, right? Finding the right people, getting them to agree to give you 5 or 10 or 15 minutes is a hard job. You don't know 50 people who might want to buy your concussion mitigation or discovery tool, no matter how great it is. So you got to talk to everybody in your med school class, everybody in the hospital you work at, every other doc you know, and network like crazy to get introductions to people who are in your segment, right? I talked earlier about attacking people in malls and Starbucks and things like that. You have to get over, if you have it, your sort of fear of extroversion or whatever. And initially, certainly in the first phase of discovery, the first time you're out of the building, don't worry about who they are they CEOs or, low-level people. You just want feedback about all elements of the sort of value chain that you're going after. And you might also want to ask every one of them if they have any ideas about people who'd like to learn from you, hear from you, talk to you, whatever, right? So there are, lots of sort of tricks about how to do this. I think I'd really rather get to questions and answers, but remember your most important conversation in the early discovery is, am I sort of making progress toward product market fit? Is this customer really representative of the hottest segment of my market? And do they start to like the problem I'm heading out to solve, or the product I'm solving it with? So how do you know, when your answers are good enough? A guy named Dave McClure, who's someone I encourage you to read and follow. His website is 500 Startups. If you like dirty language, he's got the filthiest mouth online. He says if 40% of the people talk to you say they would freak out, be disappointed, commit suicide, whatever, if your product were suddenly taken off the market, that's a good sign. I think we're without the funny words, I think our attitude is, if you hear consistently enough from an affordable segment of your segment, in other words, 2 out of 10 or 4 out of 10 or whatever it is that you need, then you kind of keep moving forward, okay? And then basically you go back out, second time out of the building, sometimes to the same people, sometimes not. Okay, I've been hearing that this is a real problem. Here's what I think is a solution. Sometimes you will actually get orders. That's usually a very good thing, but you're not hard selling the way you will be a little later in customer validation. And there are really 3 key questions that tell you when you know you're ready to move forward into customer validation, where you're going to start to spend more money trying to scale your business, right? So up top, right, kind of spans 3 boxes, right? Value prop and customer, that product market fit. Second, do I really understand not only who my most important, hottest customers are, but where am I going to find them? In the mall, in the bridal salon, online, AdWords, balloons, blimps, Central Park. And then third is, can I make money doing this and build a company sort of for the long term? And I think, in the interest of time, I think that's a pretty good place to stop and take a bunch of questions until Cynthia gets the hook in about 20 minutes, right? So, questions?
If you have questions, wait until we get a mic to you because we're recording and it wants to pick it up. Just raise your hand and we'll come to you.
And, I guess the one other thing I would say in conclusion is, any of you who think this is easy probably spent your lunch hour in Washington Square Park doing things you don't want to tell your mother about. This is brutally hard. You are going to get your head beat in. You are going to walk down dead ends into blind alleys. You're going to retreat, pivot, change a box, and try it again. And if you are a true entrepreneur, you're going to do this again and again and again until you're old like I am. Because the odds of your first company being a rip-roaring success are so close to 0. And it can take 2 or 3 or 4 of these brutal, difficult, multi-year activities before you hit the big one out of the park. And sometimes you won't even do it then. And if you are doing it for the money, you are doing it for the wrong reason. This has to grab your heart, and it's got to be much more exciting to you than the job you can't find anyway. And you've got to be doing it because you believe in what you're doing, and that what you're doing will be challenging and exciting and important. And if you're incredibly lucky, we'll make you a small boatload or a large boatload of money. So it's frustrating, it's demanding, it's taxing as all hell. And if you don't believe that, just do it for a month or two, and then you'll say, oh, I guess he was right. And so, anyway, we had some questions.
Right here.
Yeah. Okay, where's some?
Right here. Hello?
Oh, and you even have a microphone. Okay, yes, ma'am.
What if it's a product that we can market to either a smaller segment or a more general segment? Do we need to limit ourselves?
What was the last? Should we?
Should we, or do we need to limit ourselves to the niche segment?
Okay, I would say, at least at first, you want to limit it to a place where you have the greatest confidence that you can make sparks fly. In other words, it's very easy to expand, but it's very easy to run out of money trying to achieve broad reach early. One of the challenges is that some customer segments are not easy to target. So if you are targeting, let's see, if you are targeting, MBAs who work in finance but really want to get out of finance and go into marketing, it's not like there's a magazine for that or a website for that. So your targeting becomes more diffused because you have to reach a broader audience to have some of those people sort of raise their hands. Sometimes what you have to do is just make noise to everybody and hope that your segment will sort of self-identify. I built a $50 million business that way when we were selling CRM services in 1993, before anybody knew what CRM was, before there was even the acronym. We couldn't call on a corporation and know who to call on because 20 different job titles could buy CRM. So my strategy was just make a ton of noise and let them come out of the woodwork when they say, gee, we need some CRM. Oh, these guys are talking about it all the time. They seem to know something. Let's call them and see what they do. So that's a sort of broad reach strategy, but it takes a lot of energy, often takes a lot of money. And that's why we strongly encourage start with an addressable, smallest possible audience. Not necessarily for a year, maybe not even for more than 3 or 4 months. But your first marketing messages are going to be crappy compared to the one that really works the best. You're going to be continuously testing and optimizing that message. Why wouldn't you want to test it against the highest propensity customers? So at least you have that box checked. These are people that should be really interested. Let's see if message A or B or F or Q gets them to click better than the others, that sort of thing. So, and again, it's the sort of age-old startup problem of you only have so many people with so many hours in the day with so much money to spend. So you want to concentrate that as best you can to see if you can make some magic happen sooner rather than later. What else?
Hi. You have told that before we start to define the pass file, either 4 out of 10 or whatever, but how do we define? Like, is it 4 good responses out of 10 or like 5 or 7? How do we make a decision?
How do you make the decision on what the test is before you go out?
Yes.
Well, I think a couple things. First, you need to sort of look at the rough math of your business model and say, well, what do we need it to be? Right? Everybody needs it to be 10 out of 10 customers are ready to buy right now, but we know that's not realistic. And based on our first 10 or 20 interviews, we found that 2 or 3 are interested. So let's see if we can get smart enough and make our pitch good enough to get that number to 3 out of 10. And then let's do the math to make sure that we can have a profitable business over time if we get there. And if you go out and you interview 30 and you only get 6 interested parties, that would be 2 out of 10. It doesn't mean it's a failure because, first of all, you could improve that over time as your pitch gets better and your targeting gets better. And secondly, the math may work just fine at 2 out of 10, but you were maybe a little optimistic or greedy or whatever with the 3 out of 10, and you still have a viable business at 2. It's a great place to involve advisors and mentors and faculty with what you really need more than anything is a library of experience. The scary rule that I like to start with is everything is 1% till proven otherwise. I'm going to show this Google AdWord 100 times. One person's going to click on it. For every 100 people who click on it, one of them is going to spend more than 20 seconds at my website. And for every 100 who spend more than 20 seconds at my website, one of them is going to give me their email address. For every 100 who give me their email address, one of them is going to buy something. For every 100 who buy something, one's coming back to buy a second time. So I would say start there. And now convince me, convince your team, convince your advisors why your thing is so great that 14 in 100 are going to come and 16 in 100 are going to buy. And that's a very sort of logical way to begin the conversation. There is no, if there were a scientific method to this, right, we'd all be billionaires, right? And so a lot of it is sort of entrepreneurial risk tolerance and decision making, almost always on imperfect data sets, and it's one of the increasing number of places where a little gray hair can help you, not because they're so much smarter or wiser, but because they've seen these movies before, and they can tell you about the one with, Bogart and Bacall, where they got 4 out of 10, and then there was the one with Clint Eastwood in the chair where he got 0 out of 10, So you need a baseline so that the conversation isn't a feel-good or feel-bad conversation. Okay?
Thank you.
Got one down here, one up there. Okay, everybody's getting their exercise on the faculty this afternoon, right?
Hi. How do you go about validating a business that is mature and established like the restaurant business? The reason I'm asking this, we're thinking of opening a sort of fast food chain that offers Turkish street food, which you can't find in New York. And we're wondering, how do you, obviously the solution we're offering is food for people who are hungry. So how do you get more specific than that? And how do you validate your menu or your location?
Interesting, good question. I had one of these in my Columbia B School program where these guys were absolutely dead certain that Williamsburg needs a high-end karaoke bar with bottle service and no stains on the carpet and where you can do whatever you do to get your song to the head of the line for a couple of bucks and so forth. And the problem with that business or your business is eventually the decision to go live is totally binary. You either sign the lease, buy the cooking equipment, hire the people, or you don't. It's very hard to do an MVP, right? So what do you do to have a sort of fake MVP? You start by doing a couple of street fairs or flea markets, either with free samples and a little, we'll give you a free whatever it is if you'll take a minute and give us some feedback. And if you'll give us your email address, we will send you a free whatever when we open. Well, in other words, you're trying to pulse the enthusiasm for your idea, in your case, for your cuisine. So you could launch a website that talks about greatturkishtogo.com and talk about how hard it is to find Turkish food, reach out to the Turkish community, see not only do people come to the site and give you comments about, well, I'd really like it to have, goat burgers or whatever, Turkish food might be hot this week. And more important than do they comment on your blog, are they telling their friends? Because that gives you a sense of the market potential and the enthusiasm for the idea better than somebody just saying, oh, that's a great idea. And the other thing to sort of think about, is there a way to try it someplace? Have you got a friend who's a restaurateur, or I think you said you have an existing location now. Could you, without disrupting your core business, this week only special, Turkish specialties, different things every night, and see if business got better or worse in that week. And obviously you want to be careful not to disrupt your core business, and maybe it's Tuesday night, the worst restaurant night of the week. Tuesday night is Turkish night, and see if all of a sudden Tuesdays, go to the moon, right? That lots of things you can do before you sign a lease and buy equipment, because those are sort of irrevocable decisions that most of the time are going to require you personally guaranteeing the lease and the loan and things like that, and you're guaranteeing that with whatever money you have left over after you paid your NYU tuition and before you paid your mortgage. So those are fairly serious commitments with fairly serious teeth in them. So before you write those checks or sign that lease, you want to be pretty damn sure that you have a market. So, I mean, that's the short. I could talk about that or any of these questions for an hour, as you could probably tell. Yes, sir. Oh, where do?
Thanks. I have a quick question about the value of the company. So no matter what company you start, you have to come up with some money. And then we're talking about shares. And let's say I have a business model and I have some some transactions and approved working business model, but it's small. And then I'm looking for more money, like angel or VC. Then how can I estimate the value of my company so that I'm not either undersell my companies to, and how do we figure out all those informations?
Very difficult question. There are entire semester-long courses right here at Stern on that question of how do I value my company. I mean, the way I like to think about it is it's as much about speed to financing and quality of investor as it is about the valuation, because the valuation is just a snapshot at a moment in time, right? It's got nothing, it's just an artifice. It's a way to handshake with somebody about, you're going to put X million dollars in my company, and you're going to be really helpful. You've got this fabulous Rolodex and you've invested in other successful companies like mine before. I want you as an investor really, really badly. And the ratio, or how much equity you keep versus they get, and this is not what a lot of entrepreneurs really like to hear, but it's nowhere near as important as how good is that money. If you can get Fred Wilson to invest in your company, my recommendation to you is he sends you a term sheet, you sign it and send it back before he has a chance to change his mind. Because Fred Wilson is one of the legendary New York VCs who, when he signs up to be an investor in your company, he is with you 100% of the way. He's got one of the best Rolodexes for 1,000 miles, and he works it hard for his portfolio companies, and he will kick your ass just like any other investor, but when he's kicking you, he's going to say, okay, here's what I think we need to do. He also has an incredible reputation for staying with his companies. He's got a 14-year-old company that we almost invested in with him that is still not quite making it. And he has kept that baby alive for 14 years because he likes the team and he still has confidence in the CEO and the space that they're in. Most VCs don't operate that way. It's, okay, you got 2 fundings for me, you're getting nowhere, thank you, goodbye, we're shutting you down, kind of thing. And so the quality of the money is, in my personal view, and I've done this the wrong way so many times that I can't begin to tell you, we invested in a company in 1999 that was losing $7 million on $2 million in revenue, and we sold it in 2011. It was making $10 million on $80 million in revenue, and it had $10 million cash in the bank. And we sold it. We had invested $1.5 million in it. We sold it, our piece, for $1.4 million, right? From -7 to +10, $10 million in the bank. And the problem was 2 of the major investors were Fortune 50 CPG companies who will remain nameless. They wanted, it was an online research business, and they wanted this business to serve their company's online market research needs. And they drove product development for what they wanted, not for what the market wanted. And so they basically rendered the company valueless, or break even on 12 years. And I personally invested 1,000 hours in that company along the way. So yeah, they wrote big checks and did lots of stuff and spent a lot of money as customers, but they didn't have, they were much less concerned about where the company was going as opposed to what's it doing for their own businesses. But again, NYU's got great people and great courses on this, and most of you, and I'm not sure whether I get beaten for saying this, things like valuation and incorporation and protecting your IP and 10-page contracts with your co-founders, don't even think about that crap for a year or 18 months. First see if you have this incredible resonance between your product and your customers, because if you don't, all the paperwork and legal bills in the world aren't going to make a business out of it. And if you do, it's very easy to say, okay, we sort of shook hands that we were 51-49 partners, or that the 4 founders would have 3/4 of the stock, distributed based on who did what over the last 2 years. Leave all that Delaware corporation, stock certificates, all that crap, and copyrights and trademarks, until you see if you have anything of any value. Because you're going to take money away in doing all that stuff from the place you really need to spend your money. Getting to know your customers, building your product, refining the product based on the feedback from those customers. And that is, pick a number, 94.3% of the success in a startup. The paperwork is, like 0.04% of the contributor to a startup success. And I'm sure there's a bunch of very eminent professors and scholars in the room who are going to say, don't listen to him, he's crazy. It's one man's opinion. There's a trash can at the back of the room. Take any note from Bob, crumple it up on your way out. It's your business. It's your entrepreneurial risk. That's, one man's opinion colored by lots of stupid mistakes. We spent $80,000 getting a provisional patent on a piece of software, and basically by the time the patent was issued, it was abundantly clear that none of the 20 top advertising in the agencies in New York had any interest in using our patented software. Great, but we had this patent. So all you have at that point is you hope somebody rips you off, and you hope you're in business long enough to come up with the money to sue them, and maybe you'll get lucky and you'll get a little bit of money back. And if that's not what entrepreneurism is about, it's not how you want. I hope it's not how you want to spend your life, unless we have any law students in the room. It's just not fun. Better to say, okay, let's have a funeral for this company, take a week off, go lie on the beach, get drunk, and come back and figure out what we're going to do next. In fact, that leads me to one other interesting story, young entrepreneur in Moscow, presenting a very clever business idea. Truth be told, it was in the sort of biomedical space. And I said, wow, that's a really cool idea. Tell me, how'd you come up with it? He said, well, 18 months ago I was working for this big pharma company. I decided it was time for me to go out on my own. I really wanted to be an entrepreneur. So I quit my job. I had some money from my bonuses and stuff. I figured I had 18 months to figure it out. So the first thing I did was I spent 6 months talking to everybody all over Russia about 4 or 5 different ideas. I developed six totally different business model canvases that had nothing in common other than there was the word medical somewhere on the canvas, and they were all this guy's idea, right? So he spent roughly 6 months developing 6 robust canvases that he had worked over and over and over in feedback from investors, from customers, from buyers, from medical people. Then he said, then it was time to move to Moscow. And he moved to Moscow, and he started showing the 6, then 4, then 3 to investors. Which one would you back? Which one do you think has the best shot? And that's how I set